Characteristics of common stock. First, equity capital, evidence of ownership position in a firm in the form of shares of common stock. You also have publicly traded issues, shares of stocks that are readily available to the general market and are bought and sold on the open market. That'd be such stocks like AT&T, Walmart, Target, so forth. In fact, this is what you're doing in your project. You're buying publicly traded issues. Public offering. These are an offering to share the investing public a set number of shares of a firm at a specified price. Now, of course, we had an IPO here, public offering for Facebook. Sometimes, like I said, with IPO, sometimes you win, sometimes you lose on those also. Okay, let's look at rights offering, an offer of a new issue of stock to existing stockholders who may purchase new shares in proportion to their current ownership. Of course, they don't have to buy. You have stock spin-offs, conversion of one of a firm's subsidiary to a standalone company by a distribution of stocks in the new company to existing stockholders. Pepsi, to give you an example here, Pepsi, the cola company spun off its restaurant operations, which was Taco Bell, Kentucky Fried Chicken, Pizza Hut, and the spinoff is now called Yum Brands. Also, McDonald's, they spun off Chipotle. Let's look at a stock split. Occurs when the firm announces its intention to increase the number of shares of stock outstanding by exchanging a specified number of new shares for each outstanding share of stock. Most stock splits are executed with a view to lowering the price of the stock and enhancing its trading appeal. If the stock split is not accomplished by an increase in the level of dividends, stock prices will fall to its account for the split. Thus, a $100 stock will fall to $50 after a 2-for-1 split. Firms do not issue treasury stocks. These are simply shares of common stocks that have been issued and repurchased by the issuing firm. This is generally done because the firm views the stocks as an attractive investment. Perhaps the price is unusually low. Most treasury stock is later reissued by the firm and used for such purposes as mergers and acquisitions, employee stock option plans, or for payment of stock dividends. Treasury stock is not a form of classified stock. Classification of common stock simply breaks down common stock into different classes or groups. Each class has different voting rights and or dividend obligations. For example, a Class A stock might designate non-voting shares that receive preferred dividends, while Class B stock might designate voting shares with lower dividends. Some classes pay stock dividends to appeal to individuals interested in capital gains. Other classes pay higher cash dividends that attract income-seeking investors. Figure 6.4 here, so stock quotations. Of course, you can find this information. I like using Yahoo Finance. You can use Zacks, Kiplinger's, Wall Street Journal, or even your local newspaper to find this information. Okay, let's look at transaction costs for stocks here. Common stock can be bought or sold in round lots or odd lots. A round lot is in 100 shares of stocks or multiples of 100 shares. An odd lot is a transaction involving less than 100 shares. Of course, if you purchase odd lots, it's usually going to cost you more money than when you buy them at 100 per share for a round lot. par value of a stock is the stated or face value of the existent primary for accounting purposes only. Many stocks are issued with no par value, and this is relatively a useless number. Okay, the book value is an accounting measure of the amount of shareholder equity in the firm. Book value indicates the amount of shareholders' funds used to finance the firm. Now let's look at the market value, or the investment value. Perhaps the most important measure for a stockholder, indicates what value investors place on the stock. Investment value or market value is based on the expectation of the risk and return patterns of a stock. And the returns come from dividends and capital gains. And the risk is based on the exposure to holding the stock. Let's look at dividends here for stocks. The question of the amount of dividends to be paid is decided by the firm's board of directors. Directors evaluate the firm's operating results and financial conditions to determine whether dividends should be paid, and if so, in what amount. During a board of directors meeting, a variety of factors are considered in making the investment decision. They include the firm's current earnings or profits are considered a vital link in the decision of electing to have a dividend. The board also looks at the firm's growth prospect. Firms with good investment opportunities pay less dividends, using the retained earnings instead of new investments. The board also considers the firm's cash position to make sure it has significant liquidity to pay a cash dividend of a given size. The board also ensures that it's meeting all the legal and contractual constraints that might be imposed by loans. The board also makes an effort to meet the dividend expectations of its shareholders. Failure to meet these expectations can lead to disastrous results in the stock price for that company. Okay, also looking at, I would like to look at how dividends are taxed right here. Dividends are taxed currently at 15%. Now that's just for today and until December 2012. If Congress and the President do not act, that rate could go up, and that would have an impact on income stocks. People would probably start looking for other vehicles to move to find, to shield that income from taxation. Like I said, we'll find that out here in the next 2 or 3 months. Okay, let's look at key dates here when dividends are declared. The ex-dividend date, which occurs 2 business days prior to the date of record. And here is your ex-dividend date. If the stock is sold on or after the ex-dividend date, the owner/seller receives a dividend. If it is sold prior to the ex-dividend date, the new shareholder, the buyer, receives the dividend. Thus, if stocks is sold on the ex-dividend date, the seller receives a dividend. Going ex-dividend means the buyer is not entitled to the ex-dividend date, since the stock is being sold without dividend. So, if you bought the stock on June 15th, right here, you would get the dividend. If you bought the stock on June 16th, the seller would receive the dividend. Of course, that dividend would be paid on June 30th. Okay, let's look at dividends and earnings per share. Earnings per share, the amount of annual earnings available to the common stockholder stated on a per share basis. Earnings are important to stock price. Earnings help determine dividends payout. So to figure out your earnings per share, you would take your net profit after taxes minus preferred dividends divided by the number of shares of outstanding common stock. EPS is an indicator of a company's profitability. So that's why investors would be interested in the earnings per share. Okay, let's look at the dividend side of it. If you should purchase a security that has a dividend, you would be interested in the dividend yield. A measure to dividend to share price on a percentage basis indicates the rate of current income earned on the investment dollar, a convenient method to compare income return to other investment alternatives. So you take your annual dividend received per share divided by the current market price of the stock. As I've talked about my FTR stock there, I bought it around the $4 range, and my current yield on dividends there is 10%. By using the dividend yield, I can compare this with other bonds or other stocks to see if it's worth the risk taking. And of course, you guys know I purchased the FTR stock here, and this would be just one tool that you could use to see if you want to purchase a stock. Okay, now let's look at the dividend payout ratio, another ratio or tool that a investor would like to look at. This is the portion of earnings per share that a firm pays out in dividends. Companies are not, of course, required to pay dividends. So some companies have high earnings per share but reinvest all money back into the company. Now, to figure out this ratio, the dividend payout ratio, you take dividends per share divided by earnings per share. Now, investors like dividends, but do not like to see ratios over 60 to 70%. And the main reason for that is because it's hard for companies to make payouts that are high and are difficult, like I said, which could lead to problems. If a company downgrades its payment for dividends here, that will have an impact on the price of the stock, which could be a capital loss for the person that owns the stock. So this would be a tool that an investor would keep track of. Dividend payout ratio. Now let's look